Before you step into the stock market, it is very important that you should understand the basic difference between trading and investing. Especially beginners who are entering into the stock market often get confused between these two. So, today we are going to see what is trading and investing and their pros and cons. My name is Vivek and you are watching Delta Options. Trading involves identifying the market trends and then quickly buying or selling the stocks to book profits. And investing is based on buying the stocks of a company after carefully analyzing the business of that company. Anyhow, both trading and investing aim to get the profit in the stock market, but they pursue the goal in a different way. Let us take an example to see what does the investor and trader means. Say suppose you wanted to buy a new house and for finding it you have approached a real estate broker. Let us see how the mindset differs. When you are buying a house as an owner, you will think it is a dream house and you will see in the longer perspective. You will see how the quality is maintained in the construction, is the house is in commutable distance and how the community is over there. And now how the real estate broker will see is, he will try to sell the house as early as possible and take some commission from that and try to make some money in the short term. He will not see either whether the house is good or not or how is that community, anything he will not see. His only aim is to sell the house as early as possible and get some money from that. If we are relating this example with the investor and the trader, you can see that the person who is buying the house for the long term can be related to the investor, and the person like a real estate broker who is selling for the short term and making money, he is termed as the trader. Point number 1, long time horizon and short time horizon. Investors have a longer term outlook. Usually they will buy the stocks and hold for 5 years, 10 years and even maybe 20 years also. Traders jump in and out of the stocks within weeks, days, even in minutes to get short term profits. What matters to the traders is which direction the stock is moving and in how much time they are getting profit. Second difference, fundamental analysis and technical analysis. The investor will do fundamental analysis before he invests in the stock because he will invest the money to get some decent returns in the long term. That means he will analyze the balance sheets, try to analyze the business and how the company growth is there and what the company future perspective and so many other things he will analyze before buying the stock. Here, the trader will not do fundamental analysis. Rather, he will try for checking the technical analysis before he entered to the trade. That means he should get hold of the company where there is a price movement and he sees that if he enters in that stock, he will get profit or not. So basically, a trader focuses on the stock, technical factors rather than the company's long-term perspectives. The third difference, analyze the value and analyzing the price. Investor will always analyze the value of the company before he invests. That means he will not be worried on the price that much as he will be concentrating on the value of the company. A trader basically sees which price the share is trading. Here he will not see the value of the stock. If he feels the company is trading at the lower price and he thinks if it moves up he will get money, he will buy the stock even if it is the bad one. Difference number 4. Makes money only if the price goes up and makes money if the price moves even in any direction. Investor will make money only if the company share price goes up. A trader can make money even if the price goes up or down. Only thing the price has to move in the direction which he took the trade. Difference number 5. Investor checks the intrinsic value of the stock where the trader will be checking some indicators. Investor will check the intrinsic value of the share means he will see what exactly the share price can be. And if the value of the share is below that intrinsic value, he will feel that the value of the share is trading at the little lower price. So he will buy the share and he will think if the share grows higher, he will get some money. And whereas the trader will see some indicators and he will take the trades based on the indicator. If the indicator says there is some buy sign or sell sign, he will take accordingly. The same way there are traders who will do some trades based on price action as well. Here are some pros for the investor. If you are turned out to be an investor, then you might have get some good interests when compared to the other financial instruments, only if you are choosing a good quality stocks. Also, you get some passive income in the form of dividends, in the form of bonus shares if invested in the long terms. So no need to worry if the price goes down. If the company is good, it is an opportunity to add more stocks at lower price. Now let's see some cons of being an investor. Now we are seeing some investors are buying the stocks on some speculated news. An investor should never buy a stock on a speculated news. Rather, he has to check for the valuations and fundamentals of the company. Now let's see some pros and cons of the trader. First, let's see the pros. Trading is highly used as the hedge fund. That means if you are having some funds, say suppose the stock you have bought at some price and you are hoping it should go up, but it is going down. At that time, you can do some trading. Say it as an hedging. You can say that take a trade that it will go down, so that you will not have that much loss. You can minimize that loss by doing hedging. Traders jump in and out of the stocks within weeks, days, even in minutes to get short-term profits. And other biggest advantage for the trader is he can make money even if the market goes down. That means he can make money in either direction, even if the market go up or go down. Now let's see some cons of the trading. Trading is always high risk one. A trader can even lose the entire capital in few trades if he is not following proper risk management. Now here are the tips for the traders and investors to reduce your risk. That means cutting down your losses. For investor, in order to reduce the risk, you have to diversify your funds into multiple stocks. This is called portfolio diversification. By doing this portfolio diversification, your risk will be minimized. So now let's see some tips for the trader. In order to reduce the risk, you must have to place a proper stop loss. This will avoid the trader to lose huge amount as the risk will be predefined. And the final and most important tip is that figure out how much money you can afford to lose and don't trade more than that. So I think this video have helped you out to differentiate the investor and a trader. In our previous videos, I have shown you how to make some basic analyzing of the stocks. In my coming videos, I will guide you to some topics which will help you to become a trader. If you feel this video is informative, please like this video and subscribe to this channel. Meet you in the next video. Signing off, Vivek.